Hey, good to see you coming back here for another video from NetPicks. And I want to discuss an indicator called the no sure thing. Essentially, it's a momentum oscillator. And what it does is it uses the rate of change and simple moving averages to make the calculation. Okay, so what makes this indicator interesting is that it actually uses 4 different periods, and then it calculates it into one output. So as an oscillator, this no sure thing can actually be used the same way as you would any other momentum oscillator. You can use the crossover of the lines, you can use a crossing of the zero line, and you can also use it to find price divergence. Now, what about oversold and overbought readings? See, the problem is there's no upper or lower limit such as a 2080 that you'd see on like the stochastics oscillator. And that would make looking for oversold or overbought situations kind of a waste of time, because the issue is that you have no real reference point to show you the market is potentially in one of those states. So let me say right from the beginning that using an indicator for your buy or sell signals, in my own opinion, it's not the best use of any indicator. Okay, you want to use some type of price action, and that would go a long way in giving you an actual viable trading strategy. So as I mentioned earlier, we're looking at 4 different periods with the rate of change, and we use a simple moving average calculation as well. So once these are all calculated, it gives us a smoothed rate of change reading, and then we take a 9-period simple moving average of the overall calculation, and that gives us our signal line. Okay, that was the red line. Now, all of these inputs can be edited, although I always recommend start with the default settings. Trying to find perfect settings, as you've probably already found out, it's time better spent working on an actual trading plan. Because look, markets change, and that perfect setting in the market today could be vastly different next week. Now, granted, there are some traders out there who don't mind tuning an indicator, but for me, it's just not something that I personally am interested in. So how does it work? Well, the standard approach, just using a cross of the zero line or a cross of those 2 lines as a bullish or a bearish sign. Okay, remember, this is measuring momentum in your instrument. Okay, and you would use whatever tools and tactics that you personally have to enter trades. So once the indicator shows a bullish or bearish market, you want to see, depending on how you're using it, you want to make sure those lines that crossed are holding in the same direction as the crossover. So if they've crossed to the upside, you want to make sure that they're still heading to the upside. You want to make sure the indicator is holding above or below the zero line, and it's either rising or falling. Okay, so if it's below the zero line, you want to see those lines falling. So since you'd be seeing an increase in momentum in either direction, you want to be looking at more of a trend trading type of strategy to enter the market. But what if the signal lines, they don't hold, and then we start seeing the lines just mix together? Well, let's call that converging of the lines. Because when those lines start to intertwine, what you could be looking at is the potential of a trading range. And this is a 1-hour stock chart. You can see the price is in a range, and the indicator confirms it by showing a lack of sustained movements, basically going sideways. Now, you know that eventually price is going to break out of this range and be a trending move. So you want to make sure you have a range trading strategy in your toolbox to take advantage of not only the range, but you also want to be taking advantage of the pending breakout of price. Now, this feature of the indicator, it's a really good warning sign that the market conditions have changed. Okay, so in that case, you may want to seek out another instrument that's actually moving. Now, what about using it for divergence that we mentioned? So remember, when we speak of divergence, we are considering the direction of the indicator and the direction of price. We want to see each of them going in a separate direction, or essentially not confirming each other. So what does that mean? You can see here the indicator is above the zero line, so we are looking at a bullish environment. We'd be looking for long positions. But what you can also see is that, yeah, while price is rising, the indicator is falling. So that means that higher prices could be in danger. And it could also give you, as you'll see here, some pretty tough price action trading conditions when your momentum is falling. Look, choppy markets are no fun to trade. That divergence works both ways. As you see, new lows are put in with price right here, but we get a higher low with the indicator, and this points to the potential of higher prices. Now, it's not the certainty, okay? Remember, this is a look-back chart, right? Now, one of the top uses of the indicator is to use trend lines on the indicator itself. So this is a 5-minute stock chart, okay? So these are really quick day trades. So you want to make some quick plays on these breaks. So the vertical lines here, they're showing where the indicator breaks the trend line, and the arrows are showing the anticipated price move. Now, traders are going to have different techniques to enter your trades, but all of these here on a simple breakout of the previous candle high or low did give you some room to advance your stop. So what is it again? It's a momentum oscillator. Okay, it has the same use as any other one that you'd find on your charting software. Some traders, hey, you might find that having 4 different rate of change periods being used to be an advantage to your trading. When we look at trading crossovers of the zero line or the indicator lines, we got to do it with other supporting information, right? We can use trend direction with price action. We can use moving average for a trend. We can use bull flags and bear flags. We can use range breakouts or any other price action techniques. Now, I personally find that noting momentum in a trade, while it's not always going to give you big wins consistently, it does give me ample opportunity to reduce risk in the trade. So for me, risk is everything. And being able to have an objective view of an instrument that's breaking down, to me, it's always a good thing. Hope you enjoyed the video. Any questions, comments, put them below. Like this video, and we'll see you at the next video. Thanks for tuning in.